Hey guys, if you want a complete deep understanding of what trading is, especially for you who are just stepping into the trading world, make sure you stick around and turn up the volume and get a notebook and write down some notes because we are going to be jumping into some valuable information. Without further ado guys, let's just jump straight into it. First things first, what is Forex? So Forex is a global financial market, and it's also in fact the biggest financial market. It involves currency trading, for example, the euro versus the US dollar, the pound versus the Japanese yen, the NZD versus the Swiss, right, the Swiss franc. Okay, a lot of different currency pairs involved. We'll be jumping into exactly what currency pair is later, a bit more in depth along with everything related to it. But also FX stands for Forex, or the foreign exchange, and a way I like to explain this to all beginners to help simplify things is, let's just say you go on holiday, right? And obviously for you to go on holiday you need to exchange money to that local currency that you're going to. So for me, I'm from the UK. If I go to some European country, I'll therefore exchange pounds into euros. Okay, so if let's just say I go to the exchange office, or whatever you refer to as in your country, and I want £100, but I want to convert it into euros. Okay, now let's just say I get back 110 euros, and let's say I go on that holiday, but I don't spend that 110 euros at all. It's just sat there. But I come back 2 weeks later off my holiday, and I go to exchange back the 115 or 110 euros. Sorry. Okay, but this time I get back £102. That means I have profited on £2 because the interest rates have obviously changed. Okay, vice versa for the negative side of things, obviously, because you can lose money too. If I was to come back with that exact 110 euros and exchange it into pounds again, but I got £98 back, then that means I'd have lost £2. Okay, so you're basically just betting on a strong currency and trying to pair it with a weak currency. So if you think, okay, the euro is stronger than the US dollar right now, I want to buy, then obviously it makes sense to buy obviously the euro dollar based on your technical patterns, in which we'll jump into some of them later. But if you were to buy that pair and obviously expecting the US dollar to decrease and the euro to rise, that means you're betting on price to obviously head on move bullish, right? And we'll jump into all the terminology later, but that's essentially what trading is. Okay, when can you trade Forex? So you can trade Forex market. It's open 24 hours a day, 5 days a week. You know, stock or the options market or futures market, they don't have this flexibility because they have specific trading hours in the day that you're confined to. Therefore, Forex is great when it comes to flexibility. Okay, what do we trade? So we trade the value of different currencies. We trade contracts named currency pairs. So you can trade hundreds of different currency pairs. An example of currency pair is the euro US dollar, with the Aussie dollar, Japanese yen. And currencies are broken down into three main parts: major pairs, minor pairs, and exotic pairs. So major currency pairs represents the world's most important currencies, which always include the US dollar, as it's the world's reserve currency. So here's a little list of the 7 major currency pairs that exist: the euro versus the dollar, the Aussie dollar versus the dollar, New Zealand dollar versus the US dollar, the pound versus the US dollar, the dollar versus the CAD, and the dollar versus the Swiss, dollar versus the Japanese yen. Okay, those are the 7 major currency pairs that are in the Forex market. Moving on to minor currencies. So minor currency pairs represents the world's most important currencies, but disregards the US dollar. Okay, so that's the big key thing there. Minor currencies disregard the US dollar, it doesn't contain it. So there are tons of these pairs, but we don't have to name them all, so we're just going to name a few. So you got the euro versus the pound versus the Japanese yen, the New Zealand dollar versus Japanese yen, and the pound Aussie dollar. Okay, you got the euro Aussie dollar and the CAD Swiss as well. Okay, there are many minor currencies out there and many exotic currencies as well, but these are just a few that you should just be aware of. Okay, now exotic currency pairs represents one popular currency pair and an emerging markets currency. Okay, so a couple of examples would be the US dollar Mexican peso or the US dollar Turkish lira, right? Those are the two exotic currency pairs. Okay, there are some out there, but essentially it's just a strong currency versus an emerging market currency, or a popular currency versus the emerging market currency. Okay, Moving on to the next one, we have conclusions of what we've learned so far. So I'd highly suggest that you just stick to trading the major currency pairs due to them having the most money flowing around. Overall better trading conditions as well to trade, and just most people trade major currency pairs. Minor currencies are okay to trade, but majors are generally better just to be trading, okay? Exotic currencies have terrible conditions, so I wouldn't really even bother looking at them, especially when it comes to something like spreads, which you'll learn a little bit more about soon, okay? So here's a bit currencies in depth, okay? So as you can see, you got the base currency and the quote currency. So in this case, because it's the euro versus US dollar, the euro is the base currency and the US dollar is the quote currency, okay? And this is a currency pair. So base add quote equals currency pair price, okay? Now, this is the current EU price. So 1 euro represents 1.07606. Okay, obviously if price was to go to 1.08606, then that means 1 euro equals that many dollars. Okay, so that's all it is when it comes to comparing the euro to the versus US dollar. That's essentially how it is when you look on TradingView and you've got all the different price tickers. I'll talk about platforms and stuff like that later, but you've got different price tickers, and depending obviously where the currency is, like for example, it's got the euro versus the US dollar, that means 1 euro equals blah blah blah, okay? No, so when it comes to making money in the markets, if we sold or went short, so short means that we're selling the euro dollar at 1.07606 and the price went down to 1.07550, you would make money because you had sold and you closed at a lower price. Vice versa, if we bought or went long the euro dollar at 1.07606 and the price went up to 1.07670, then you would make money because the price had risen, okay? So we're essentially just betting whether or not the market will go up or down, and we make money by forecasting which way the currency pairs may go and buying or selling or going long and short in that direction. So if I think the euro dollar will move bullish for the next 1 hour or whatever time frame I want or whatever I anticipating, then I would go long or buy the euro dollar. Vice versa, if I thought that the euro dollar will move bearish for the next whatever time frame I want, I would go short or sell the euro dollar. By bullish, that just means up. By bearish, that just means down. Bull versus bear, okay? Bullish and bearish. So this is a little bit more of a terminology type thing, but long, so going long in the market means that you're buying the market. Going short in the market means you're selling the market. And obviously, if you're bullish on the market, that means the market's going to move up. And if you're bearish, that means the market's going to move down. So if I say I'm bullish on the euro dollar, then that doesn't mean that the market's going up now, but it means I think the euro dollar is going to move up at some point, okay? Vice versa, if I say I'm bearish on the euro dollar, then that doesn't mean the market is going down now, but it does mean I think the euro dollar is going to move down, okay? Trading styles. Now moving on to trading styles, you can trade the Forex market however you want. In other words, in any time scale you want. For example, you can decide to get in and out of the market in just a matter of a few minutes, or you can hold the trade for many months to a year if you really wanted to. Now these different styles of trading has different names. So you've got scalping, so this is where you hold trades from seconds to just a few minutes. Day trading, which is where you hold trades from a few minutes to a few hours. Swing trading is where you hold trades from a few days to a few weeks. And position trading, hold trades from a few months to a few years. Okay, personally, I'm somewhere sort of in the scalping to day trading category. I do swing trade every now and then as well. I never really position trade. If anything, I position trade in other markets, but that's that, okay? Most common ones are scalping, day trading, and swing trading. Position trade is more of like an investor standpoint, okay? But which one is best? So besides scalping, day trading and swing trading being the most common ones, I would highly suggest to you as a beginner to focus on swing trading. Just because it is the most easiest and passive way to trade, especially if you have a full-time job. It is also the easiest to master as well, if that's what you wanted to say, right? All that you need to do is find a trade and let it run for a few days to a few weeks. You usually just stick to trading the higher time frames as well in these cases. So for example, maybe sticking between from the 1 hour to the daily or the weekly. Those sort of time frames will probably do you best in order to get in and out of trades and hold it for a longer period of time as opposed to using the time frame. The way I see it is, for example, like scalping, that requires you to be on the lower time frame, so seconds to the minutes time frame. Obviously day trading is from the hourly-ish time frames to the down to the minutes time frame, and obviously swing trading is you know, pretty much on the hourly time frames and up. Okay, so trends. There are different market conditions in the markets, right? There's trending and consolidating. Trending means price is moving up or down, which is a very healthy and nice moving market. Consolidation, on the other hand, or consolidating, means price is just moving sideways or just in a range bound market. So it's better to trade trending markets, so obviously just because it's a little bit healthier and you can find trades a little bit easier as well, as opposed to prices moving up and down. But I mean up and down in the same sort of area, because that's what ranging is. It's like support and resistance. We'll jump into that later. But it's always better to just try and find a trending market. So if you're filtered, if you have like a few currency pairs in your watch list, for example, then it's probably better to try and filter out the ones that are consolidating, just focus on the ones that are trending. Okay, so moving on to pips. I mentioned this a little bit earlier in the video, but what is a pip? So the currency price of the euro dollar that I've shown you before is made up of pips, and that's the price for a currency pair. So when counting pips, always start one number from the left. Always ignore the fraction on the far right, which is a pipette. Okay, counting pips is important, but we'll cover that later. So as you can see here, guys, I'm going to go a little zoom in here. So 1.0 represents 1,000 pips. Okay, 1.07 represents 100 pips. 1.076 represents 10 pips, and 1.0760 represents 1 pip. Then this little number here on the far right, that's just a fraction pip, which is also referred to as a pipette. We just ignore that, it doesn't really have any relevancy, so it's better to just ignore that one and just start from 1 to the left. Okay, so for example, if I was to say the euro dollar price right now, I'd say 1.0760. that means like 760 pips from 0. Okay, that's essentially it, but that's pips. It's very simple. So if this was to rise up by 1, that means price has gone up by 1 pip. Okay, so moving on to what is technical analysis. So when we approach the markets, we need to figure out key points to buy or sell. Technical analysis allows us to do just that. We find key points where we want to buy or sell depending on the trend. You'll find out my approach a little later in the course if you are in that, because this video is from the course. I forgot to mention that, but it's a free video for you guys on here on YouTube. A lot of the people that are in my course are more advanced traders. So if you are a beginner, guys, I'd highly recommend that you check out my course, because I've just designed a clear roadmap to get you a consistently profitable trader and funded within 12 months. You can use code MASTERCLASS at checkout for £170 off your first order. So guys, make sure you go ahead and check that out, because it was definitely a life-changing course, so to speak. We've seen great success already within the past 2 weeks of launch, and it's just an amazing course. You know, I've got almost a decade of experience in the markets. I've been trading since 2016, actively, that is. And you know, I've been in the markets for a long time. I've experienced different, you know, market conditions, obviously pandemic, global pandemics, things like that. So I've got a lot of experience, and I just thought I'd put that into a course and share it with you guys. So again, if you are interested in following that roadmap, go ahead and check that out. But if you want my exact approach, I'd definitely recommend to go ahead and check out the course, or you can check out my other videos. That'll help you, obviously a little bit as well. But yeah, check out my course, guys. But this video, let's just jump straight back into it. So, what is risk management? Risk management is arguably one of the most important things. Okay, so as we were essentially betting on the direction of a currency, sometimes we are guaranteed to be wrong. So losing is inevitable. I want to put this into your subconscious from day one. Make sure you understand, guys, as new traders, you accept the losses, because most traders, when they come into trading, they just can't handle the losing, the losses. Obviously, they want the quick money. They're quite greedy, but losses is what actually makes us grow as better traders, and actually allows us to make money. So just remember, losing is inevitable. You know, you can be wrong more times than you're right and still be profitable. That's something called risk to reward and win rate, but we'll be jumping onto that later as well. So, in fact, most traders are wrong more than half of the time. Like I just mentioned, for example, you can take 10 trades, lose 6 of those trades and still be profitable. You can take 10 trades, lose 7 of them or 8 of them and still be profitable as well, based on those 2 to 3 trades. The true success comes from balancing the wins and losses, not trying to get rid of losing altogether. Like I said, guys, losses are inevitable. So now we know we may lose the portion of the trades we are going to take. We have to use what is called risk management. And risk management includes strategies or systems like taking trades with smaller position sizes, being prepared to cut losing trades, and obviously always having a stop loss as well. You'll learn risk management systems a little bit more in depth later on, especially if you're in my course as well, guys, because remember, this is a video taken from the course. So I really hope you guys are getting some value from this. Brokerages. So now you know the fundamentals of trading. There are some things that you need to get started with trading, and that is a broker, a charting software, a trading account, and obviously, first things first, what is a broker? So a broker is simply a middleman between the traders and commercial banks who facilitates our trades. And when we take a trade, usually this is handled by the bank, but we don't go directly to the bank as that is time consuming. We aren't allowed, it's too difficult, and we just don't live in the 80s anymore. Okay, so instead we place trades through a broker in which they instantly execute it and handles everything for us. If you don't have a broker, you cannot even place a trade, so it's a must and there's no way around it. It's important to choose your broker wisely, as there are a lot of shady ones out there just looking to take your money. If you want a good broker, check out the ones that I recommend, as I've been trading with them for most of my 8 years of trading. So I'd recommend most definitely Future Markets, IC Markets, link down below for them. Go ahead and check them out. They're regulated. They're just amazing brokers. I've had no issues with them. Broker fees. So brokers make money in two ways, through spreads and commissions. So what is spread? So spread is the difference between the buying price and the selling price that your broker is offering. So the bid and the ask. So on your trading account, you will see two different prices for a currency pair, which is the bid price and the ask price. Bid price means a broker's buying price, and the ask price means broker's selling price. The bid price will always be slightly lower than the ask price. The broker will charge you a small fee to buy a currency pair, and they won't buy it back for as much as they sold it to you. Usually though, the spread is only less than 2 pips, especially on the major currencies. That's why it's important to stick to major currency pairs, because they have tighter or lower spreads. Okay, spread will always interfere with every trade that you take, so make sure that the broker you choose is definitely a good broker. What is commission? So commission is a fixed fee that brokers will charge you for getting in and out and getting out the trades as well. Commissions aren't usually charged on every account, as they will usually fix it into the spreads. However, I prefer commission just because it means you get lower spreads. So like for example, on my IC Markets account, it's a raw spread account, which means I get very tight spreads and I just get charged a fixed commission per one lot traded. Okay, so you can pick the high spreads or pay commissions, but for me personally, I prefer commission just because I get tighter spreads out of it. I would not worry too much about the broker fees, because if you're a good trader, fees are cheap enough to be overwritten by your profits essentially. Okay, so if you're worried about getting all these fees and stuff like that, I wouldn't even worry about it, guys, because obviously if you're a good trader, like I said, it's going to be overwritten by your profits anyways. So moving on to lot size, as I mentioned, you know, the one with IC Markets, they charge a fixed dollar amount per lot traded. So what is a lot size? The lot size, which is also referred to as a position size, is something that you must calculate prior to every trade that you take. It is just essentially the size of the trade you want to get into, and a standard lot is 1, which means, which is the equivalent to buying $100,000. This doesn't mean you can just open a $10 account and place a 1 lot trade, as there are restrictions. In order to trade this big, you must have minimum $10,000 or more. And when you're starting out, you most likely will be trading micro lots, which is lots like 0.10 or 0.05, anything between them. Okay. The smaller your lot size, the less you make and the less you lose. If you trade big lot sizes, you can make big money, but you can also lose big money as well. It's always important or best to start off small, not rush it, and build your way up over time by always following the risk management rules. Also, this quickly leads me on to compound interest. There is something called a compound interest, which is very important in trading, guys. I've done a video on that already, so go ahead and type in ZCFX trading compound interest, or just go onto my YouTube page and try and find that video somewhere. It'll be on there within the last few uploads. That is a very valuable video, and it's not something that's spoken about within the trading industry. Moving back onto the video, how do you determine what lot size to use for each trade? That's very simple. You can use a lot size calculator. There are loads out there, but I like to use my FX book. Okay, so my FX book here, as you can see, guys, very simple. I'll put the link down below for this as well. You just go over to MyFXBook website, type in the position size on Google as well, and it'll come up. Okay. Once you're on this page, you want to put in the currency pair that you're trading. So for example, I'll put in euro dollar. Number 2, you want to select the currency you're trading and your trading account is in. So for example, dollar, right? So let's just say my account is in the US dollar. I'm trading euro USD. Then you want to input the size of your trading account. So if I have $10,000, then obviously I'm going to put 10,000 there. Or if I have, 20,000, I'm going to put 20,000 there as well. So it's just your capital. Next up, you want to input the percentage of your account that you want to risk. If I'm going to be honest, guys, I wouldn't really recommend to exceed 1 to 2%, especially as beginners. I still don't, even after a decade of trading nearly, I only stick between 1% to 0.5%. I don't need to go any higher. There's just no need, okay? And you don't need to risk 5% or 10%, especially 20, 30, 50%, because within a few trades, your account's gone. And that means you lost all your money, all right? And next, you want to put your stop loss in pips. So stop loss in pips is very simple. If you're using TradingView as your charting software, which obviously a lot of people do, TradingView is the ultimate trading software. What I will do, guys, I'll put a lot of links down in the description below. Go and check them out. I'll put like trading software, send a link to it, broker, send a link to it, etc. You get the idea, okay? Input your stop loss in pips. And then next up, you want to click calculate, and then this is the lot size that you should trade with. Okay, it has units as well. I know if you are trading directly through TradingView, they use units, so you can put that on there. But if you're using a broker and you're having like an app like MetaTrader, then that is simply what you want to put in there. Okay, so in this case, if I have a $10,000 account and I'm about to trade euro dollar and I have a 12 pip stop loss, then I'll place 0.83 lots on that trade. Okay. Now, what is leverage? Leverage is money that you borrow from your broker to open trades. The smallest possible trade that you can open with your broker is 0.01 lots, which is equivalent to $1,000. Meaning to open this trade without using any leverage, you would need $1,000 in your account. And the maximum you can make of this trade is $3 or $4. So for you to make a lot of money or make a living without using any leverage, you would need to be trading with at least 7 figures in your account without using any leverage. So to get around this, the brokers build leverage into the account, and leverage typically ranges from 1 to 10 all the way to 1 to 1,000. But trading with 1 to 1,000 is a little bit ridiculous and is just not needed. 1 to 10 leverage means that you can trade 10 times your trading account. 1 to 100 means that you can trade 100 times your account, or obviously 1 to 1,000 is 1,000 times your account, but you really don't need that, guys. You do not need to go over 1 to 50, to be honest. So use that as a base or anything below. With leverage, there are no interests or fees for you to be aware of. It's just a tool that is built into every broker, and brokers will close your trade automatically if you get too low on the account. So there's no need to worry about going into debt with them or anything like that. They have like a automatic stop thing where you'll get like a margin call, or if you get too low on the account, etc. Right? So what is margin? So when you put money into a trading account, that money is used as margin. So if you put $10,000 into a trading account with 1 to 40 leverage, you will have you'll have $400,000 worth of buying power, meaning that you can open up to 4 lots. But your margin would be $10,000, so the broker would not let a loss exceed $10,000. If they thought that was going to happen, they would give you a margin call. And this is just a notification to tell you to put more money into your account, or they will start to close your positions. But it's important to never get yourself into this position, so your main goal should be to never see a margin call in your career. So from this day onwards, never get a margin call. You can write it on a piece of paper if you really want to, but you won't, especially if you're in my course, guys, or in my Discord. No one's had a margin call in my course. The only possible way you'll see margin call is if you do something stupid and risk all of your money. So for example, like putting 90% or 80% on a trade in terms of risk. That's just stupid. I'd never ever do that for you guys. If you want to take this business seriously, because this is the business at the end of the day, it's a career. It's not a get rich quick scheme. If anything, it's a get rich slow scheme. Okay. You don't want to rush anything, guys, and when it comes to trading. You want to just take your time, slow the pace down, think long term, and just focus on compounding your account over the long term. Okay. But again, this is why risk management is obviously the absolute key to surviving. If you want to survive in the markets, you need to have utmost, knowledge on risk management. So now you understand what a broker is and how they operate, it is time to set up your trading account. When you open an account, you'll have two options. You'll have a demo account or a live account. When you begin your trading journey, I strongly suggest you to open up a demo account. Probably after this video, if you're new trading, I'd definitely recommend to go over to a broker's website, especially the ones that I linked below, and just open up a demo account and just start practicing. And a demo account is just fake virtual money, so you can't make or lose like any money. You can't withdraw anything like that. You can trade the live markets without risking anything, so it's just really good practice, and I'd recommend to just sort of focus on that for the first 3 months in your career. A live account, on the other hand, is an account that you can put money into, so real money, and this is where you make and lose real money as well. So when you are profitable on demo, you can then transition onto a live account. You can go to a broker's website, create an account, and set up your live or demo accounts. It's very simple. Once you create the account, they'll usually email you with your login details, and then you, depending on obviously what software you want to trade on, you can trade on MetaTrader. I'd recommend you to trade on MetaTrader 5 or MetaTrader 4. There's not really any difference. It's just up to you. I personally trade MetaTrader 5 for those of you that are interested. There's also an option CTrader as well. That's quite a common one. And obviously with prop firm and things like that these days, which we'll discuss later, you have the option to trade like a mass trader or a trade locker. But if I was you, I'd just try and stick to MetaTrader for your trading and placing your trades, and then using trading for you for your charting software. It's very simple to use once you get used to it. I've got a video I think on how to set up trading and things like that. If I haven't, I will upload them. So make sure you stick around for that one. But I think I have, so check that out. But yeah, for the first 3 months in your trading journey, guys, or your trading career, I definitely just recommend to stay with trading on demo account just while you're learning and you're practicing. Then obviously once you find your feet a little bit and you have a bit of an edge in the markets and you start to make a little bit of money, then sure, you can put a small amount into a live account and see how you get on. And then just, like I said earlier, just take it slow, guys. There's no need to rush anything in the markets. So trading platform. So now you have your trading account set up. I've already mentioned about MetaTrader before briefly, but you must understand that you cannot place trades on their website directly unless you have a web trader platform, which is usually pretty shy, if I'm being honest, guys. But you need a trading platform. So for this, I suggest using MetaTrader 4 or MetaTrader 5. You can download this on your phone or on your computer or laptop, which can be found directly through the broker on what is usually labeled platforms. So try and find that in the account or client area, especially if you're using IC Markets, just the client area. It'll be on the left side of platforms. Download MetaTrader, and obviously when you go to open up a demo account, make sure you put the platform that you have just downloaded, okay? Because you don't want to just like open an account, like demo account for CTrader, and then download MetaTrader. But yeah, open the app and then you'll be able to log on using the credentials that you received when you created your account. They will usually email it to you, or it will be in the client area as well. And guys, if there's any issues, you can always just contact their live support as well. There's live support there for these brokers, and they're usually pretty helpful and quick as well. But just like that, you have a trading account ready to start trading. There are obviously some documents that you need to verify to open up with a legit broker, just proof of residence, things like that. Pretty simple concept, documents, but that's pretty much it. Moving on to market orders. So now you have your trading account set up. There are 5 different market orders that you want to choose from to trade. So you got market execution. This is just where you buy or sell and instantly be in the trade at the current price. Buy limit. So this is an order that will trigger once it reaches your buy level. So if the price is below your current price. Sell limit. This is an order that will trigger once it reaches your sell level. So price above the current price. Buy stop is an order that is placed above where price is, and once it reaches this level, you'll be triggered into a trade. So for example, if you're below the price you want to buy at, if you put a buy stop, once it hits that price keeps going up, then obviously you're in the buy position. Vice versa, a sell stop is an order that is placed below where price is. Once it reaches that level, you'll be triggered into a trade. So for example, if you have a price you want to sell from, which is below the current price, and it hits that price that you want to sell from, or your sell stops at, and then it just keeps going down, then obviously you're in a trade as well. Market execution, obviously the most common way of trading. They all have different uses in the markets, and you may not necessarily use all of them as well. I personally only use the market execution or limit orders. I never really use stop orders. To be honest, I can't really remember the last time I used a stop order. The last time I was quite, a solid few years ago. Stop loss. So obviously, what is a stop loss or SL? So stop loss is a type of order, but these are really important and must be placed on every single trade. And without it, you can blow up your trading account. Remember, when I mentioned earlier that you cannot win every trade, it's just not possible, and losing is inevitable, etc. And you want to cut your losses. That's what a stop loss is. It's an order that will automatically close your trade at a loss if the price reaches that level where you place the stop loss. Okay, so it's the number one rule of risk management is to always have the stop loss in your trades. No doubt about it. No questions asked. Always have a stop loss. Stop loss is 100% important, and you must be placed with every trade. It also means that you don't sit and have to sit and stare at your charts and monitor every price movement. You can simply just leave the desk and let the trade play out as well. Take profit, on the other hand, is just the opposite of a stop loss. So it'll take you out for a profit at the desired price level that you want. Okay. Here's this TP and SL a bit more in action, but as you can see here, you got the stop loss. So you have your entry, stop loss, and TP. Okay, so entry is the current price you're selling or buying from. So if you just look at this example here, we're going to be buying your USD at the current price right now. And we have a stop loss down here, which equates to $1,000. Let's just say we have, $100,000 account, and we want to risk 1% of it, therefore, which is obviously $1,000, right? And we want to target a risk reward of 1, 2, 3. And that obviously is $3,000 because it's 3% of 100,000. Vice versa, when you're selling, you got your entry, stop loss, and take profit. So you always want to enter with a stop loss, and you always obviously want to enter at the current price or limit order. But number one rule is to always have a stop loss. That is just the basics. Number one rule: don't ever trade without a stop loss. Even if you sat there monitoring it, because you'll never know what happens. There could be some huge black swan event. Okay, you just don't know. TP, I don't really set. I set TP sometimes, especially if I'm not on the charts. But if I'm not on the chart, if I'm on the charts, I will manually close my trade a lot of the time, or for managerial structure. Therefore, I'm manually trading with the trend. So sometimes I will just leave my TP open and let it run. Sometimes I do have a TP, but it just depends on obviously the way that you trade in your system. Obviously, if you trade my way, then it'll be similar to what I'm saying now. So when it comes to risk and reward, like I just mentioned then, when we set our stop loss and take profit, we want to use a strategy called the risk versus reward. This just means we are looking to win more on winning trades and than we lose on losing trades. So you might have your stop loss set at $1,000 and you'll take profit set at $3,000. Okay, that way if the trade plays out and you win, you will gain $3,000, and vice versa. If you lose that trade, you will lose $1,000. So going back to the example of taking 10 trades, losing 6 and winning 4, this simply means, we just look a little bit here to down, as you can see, 6 losing trades means that you lost $6,000. Obviously, again, this is just with a risk reward of 1 to 3. 4 winning trades means that you've made $12,000. Okay, so therefore you got a total of $6,000, even though you've lost more trades than you've won. So you've won 6 trades, lost 4, but you still come on top and banked $6,000. This is the power that risk rewards holds. Again, this doesn't just mean go and target, huge risk reward. It's just not that simple. As much as we'd love to, it's just not that simple. How much do you need to trade with? So to make money through trading, this will vary depending on where you're from, but ideally in the $50,000 to $100,000 region, just to really go full time with it. But again, it just depends where you're from. If you're from a country that expenses are things like that, and the cost of living is quite low, then you probably don't need as much as, so for example, living in the UK, right? Now, to gather this money together, it is literally impossible unless you have that sat in a bank or investors around you, which for the majority of people listening, you probably don't have that, which is fair enough. I didn't too. However, this is where prop firms come into play. Okay, now there is something called compound interest as well, guys. Like I said earlier, go ahead and check that video out because that will make a lot of sense for trading. But this is where prop firms come into play when you want capital that you don't have. So prop firms, what is a prop firm? So a prop firm is a company that will give you access to funding after you complete a series of challenges to prove you're a profitable trader. And depending from which prop firm you choose, you can scale your account up to 7 figures onwards. You initially go through an evaluation phase where you trade fake money, which is a demo account, where you have to make a small profit without breaking the drawdown rules. Drawdown just essentially means like the minus. So for example, if you're down $5,000 on your account, then you're in drawdown of $5,000, right? If you can do this, they will give you the account in which you can trade and get to keep 70-90% of the profits that you make. Getting involved in prop firms is fairly cheap. You can pick up smaller 5 to 10k accounts for around $20 to $50, depending on the prop firm, or a $100,000 account for around $400. I am very close with a company called Goat Funded Trader. They are a top 10 company, prop firms right now, and they're fairly still quite new, to be honest. They only opened, I think it was last year or the year before. But I see a lot of potential in them. They're always adapting. They're just launching a futures prop firm as well. But I definitely recommend to go ahead and check out Goat Funded Trader. There will be a link below for that as well. They run amazing deals as well. For example, one of the most recent deals was you could pick up, I think it was an 8k account or just a 5k account for $19. So you really can't go wrong. This makes it one of the biggest opportunities in modern day trading. Prop firms, we don't know how long they're going to be around for, because obviously, you know, regulations etc. may kick in. They're already starting to, mainly for American based firms. Luckily GFT are based in Spain as well, so make sure you go ahead and check them out, guys. But right now, you know, if you can just spend the next 12 months focusing on, within the first 3 months, just follow my roadmap really. If you're in the course, just, you know, if you really want to take trading seriously, just invest, you know, a couple £100 into trading education. But something that can really change your life it's worth it. It really is. Because once you learn the skill of trading, it never goes. Well, you know, and it's only bullish once you start trading, because you only just keep getting experience, and the more experience you have in trading equals the more conviction you have in your trading as well. So, you know, once you just keep going. But going back to what I was saying anyway, guys, just spend the first few months on the demo account practicing, getting used to everything, placing these stupid trades, doing whatever you want to do. Just get it all out your system and then lock in a little bit. Like I said, if you're in my course, study my approach, and then obviously focus on that for the next 6 to 9 months, whatever. And then from month around 10 to 12ish, you can then start to trade with real money and look at, you know, prop firms and things like that. But again, you know, that's another thing as well. In my course, I teach you how to actually be able to pass prop firms as well, using my system as well. But many of my past and current students have achieved funding status and received multiple payouts, so it's there, the proof's in the pudding. A lot of my students are just absolutely killing it. So if you want to be a part of them and join the 1% of traders, you know, 5 to 10% of traders over, just check out the course, guys. I'm not trying to push it down your neck, but you know, I wish I had what I was offering when I first started trading. I really did. The last thing you are going to need is a charting software, but there is no competition out there. TradingView is easily, I've already mentioned this, but there is easily the best charting platform that is out there, and that is where we analyze the market to get in and out of trades. So basically, I use TradingView to mark up my euro dollar chart, for example. Okay, so this is where I'm annotating it and marking it up, thinking what I'm thinking, drawing up what I feel, etc. Follow my approach, and then I use the MetaTrader to actually place the trade on my phone. I usually just place it on my phone, and then use the TradingView on my computer or a laptop. Okay, it does say here I will show you ways to mark up the charts to effectively get in and out of trades later on during the course, but obviously that's in the course. But for now, guys, this has just been the beginner series for all the traders out there. If you need to, guys, go ahead and watch this video again, back to back. There's a lot of information, a lot of valuable information here, but for the beginners who are just stepping into trading, this is all that you really need to know. So the next step for you now is to just go ahead, look at opening a broker, and I would recommend to obviously jump into my course, but just open up a broker, download it onto, download MetaTrader, get logged in, and just start faffing about and just start trading, and then just, figure it out for yourself from there. Obviously, if you want guidance, I'd recommend to check out my old YouTube videos as well. There's a lot of information on there, guys, like trade recaps. You can start to figure out the way I sort of trade, and it will sort of give you guidance on what to do when it comes to mapping up the charts. I've got videos out there like my best entry model. So there's a lot of information out, guys. Just go ahead and find it, study it, write down notes, and just put in some hours, and just put in some, you know, I'm going to be honest with you guys. There's going to be a lot of the times where through trading you're going to be thinking, this is not for me, I don't know why I chose this. But guys, if you can just stick to this for the next year, especially with the right guidance, you will become successful. There's no doubt about it. So yeah, that's pretty much it, guys. Thank you so much for watching. Take care, and I'll catch you on the next video.